Welcome to Allan Reports TV. I am your host, Allan Labucan from allanberryreports.com. Today we have a new installment of our market commentary segment, and we'll be talking about trends and developments we are seeing in the markets. Before getting started, I always like to send out some thank yous. First of all, YouTube and Ustream. We use these websites, that's youtube.com and ustream.tv. We use these sites to produce the shows, to broadcast the shows, to record the shows, and they're great websites. If you are interested in doing shows, we highly recommend them. Also, we want to thank our banner sponsors. If you look to the side of me here on the left and the right, you'll notice a group of sponsors. Those companies help us to be able to produce these shows, and if you click on their banners, it'll take you to their websites where you can go and do your own homework on those companies and check out what you think of them. So again, thanks to the banner sponsors, and of course, thanks to you, the viewers. If you didn't show up, we wouldn't have much reason to do the show. So thanks a lot for coming. On today's show, we'll be discussing commodities, currencies, and resource stocks, and we'll start with the U.S. dollar. Back in our Outlook 2010 report, that was in our 27th edition of our report. If you look above there, you can find our report section, and in there, you look for the 27th edition, and that's the one that we put our 2010 outlook in, and we were expecting the U.S. dollar to be continuing on its bearish trend that it's been on for a few years, or for several years. We've been wrong. We were wrong earlier in the year. We didn't foresee some of the sovereign debt issue concerns that arose earlier in the year relating to some of the countries in Europe. And this sort of gave some wind, it put some wind in the sails of the U.S. dollar. Although we think that the fundamentals of the U.S. dollar are not good, and we've seen the resumption of the bearish trend for the U.S. dollar continue, and those fundamentals, poor fundamentals, are still out there. So we think that long-term bearish trend is going to continue. So we were wrong for the first part of the year. We're now right again, and we think that as we go towards the latter part of the year, that bearish trend will continue. With the case of the U.S. dollar, what you have is abundance. You've got abundant debt. The country's fundamentals, they're running up huge deficits. They're running up huge debt. This is not good. They're printing a lot of cash to try and stimulate the economy. This is not good for long-term fundamentals of the dollar, and that's in a nutshell why we think it's going to continue on a downward trend. You got lots of debt, lots of dollar printing, and ultimately, when you have assets that have abundant supply and suspect demand, that is a recipe for a bearish trend, which we think the U.S. dollar is going to continue. So then, with commodities priced in the U.S. dollar, they have sort of an inverse relationship. When the dollar is down, it drives the prices of commodities up. And often cases, the reverse is true, where if the U.S. dollar is going up, commodity prices are going down. Although, when we were in the early part of this year, commodity prices were pretty buoyant, even while the U.S. dollar was catching a bit of a bid there. So, and that has a lot to do with the fundamentals of supply and demand. And so, we think that the situation with the dollar is very bullish for commodities. Now we'll get into the commodity side of things, and As I mentioned earlier, we had in our Outlook 2010 report. By the way, if you're interested in receiving our email newsletter, there's no charge for the reports. There's a subscription above me there. Just subscribe, and we send you out notices whenever we have reports out and what we're working on. And it's a really great way to keep informed about what we're working on. And in our 27th edition, again, it's up on the report section there. When we talked about our Outlook 2010, we also talked about what we expected to see happening with gold, silver, oil, copper, and other assets. We're going to talk about those commodities today. And in the case of gold, we were looking for a bullish bull market for gold that would take gold considerably higher through the year. That's exactly where we are. We were looking for it to get up to around the $1,500 level by the end of the year. We think we're on track for that. When markets move up quite aggressively, you can see some short-term pullbacks, but generally the pullbacks are short-lived, and the resumption of the upward trend is pretty quick to get going again. And so we think that we're in really good shape to see that $1,500 level this year. Silver, we also had a very bullish outlook. We felt that silver would outperform gold. It looks to be on that trend this year. We're looking for $25 before the end of the year when we made those predictions early in the year. And so we're pretty happy with the direction for silver. Oil, basically, I will get into the basics of why these are moving so quick, but first I wanted to talk about oil and copper. In the case of oil, oil is pretty well supplied on a short-term basis over the next couple of years. But where it starts to get into trouble is you look down the road further, and the supply looks not well prepared for that demand that's going to be coming from recovering developed economies, and then the economic powerhouse of growth from the emerging economies. So in a long-term sense, we don't think that supply is well prepared to meet future demand. And then we have copper. In the case of copper and oil, those two commodities are exceptionally good economic indicators. And long-term supply is weak for copper, and demand is very strong. But we can also, on a short-term basis, use oil and copper as very good economic indicators. The basics are no economic growth happens without those two commodities. You need those two commodities in order to see economic growth. And so what oil and copper are telling us is that the global economy is in very solid shape right now. The recovery of the global economy is in very solid shape. Now, oftentimes, when people are looking at the markets, they sort of are America-centric, if you will, and we're more of a global, looking at things from a world perspective. We're in a global economy, and what happens globally, with the emergence of many countries' economies like China and India with massive amounts of people in them, they're going to have a growing influence on the price of many assets, including commodities. And we think that as we go forward, in the past 100 years, you could pay a lot of attention to the American economy because it was the engine of global growth in the past 100 years. In the next 100 years, that engine is going to be the emerging economies. Now, that doesn't mean that the U.S. economy isn't going to be important. It absolutely will be. But that exceptional economic growth is going to come from the emerging economies as they modernize, if you will, and start to get all the amenities that we have in the developed economies into the emerging economies. So, and with such massive amounts of people, they're going to be consuming a lot of commodities and products. And so what happens with commodities is very important, or what happens with the economic growth of China, India, and other emerging economies is really important in a global sense. And so we're global centric when we look at the economy, and what we're seeing from oil and copper is that the global economy is on pretty solid footing when it comes to the recovery post the 2008 calamity. In a general sense, we're bullish moves in commodities are very bullish for resource stocks. I mean, it's pretty basic. If the price of a commodity is going up and a resource company has that commodity in the ground, the assets that they hold are going up in value. And the basic argument of why we prefer select high quality resource companies over the commodities is because you can buy what's in the ground relatively cheaper than what you'll pay for it above the ground. What I mean by that is when it's in the ground and hasn't been pulled out of the ground yet, it's a lot cheaper than on a relative basis. Now, when I say relative, I'm taking into consideration the costs of producing that, developing production facilities. That is all part of my relatively speaking comments. And in a relative sense, you can buy commodities in the ground a lot cheaper. And that's why we prefer high quality select resource companies over commodities. In our opinion, resource stocks are still trading much like they were when, for example, gold was trading under $1,000 and silver was under $15 and copper was around $2. Many resource stocks still have a lot of catching up to do relative to the moves in commodity prices, and we think select high quality resource stocks will significantly outperform bullish moves in commodity prices as they start to reset their valuations relative to the reality concerning current commodity prices, and especially for future bullish moves for commodities that we see coming. The bottom line is assets like the US dollar and US debt or bonds that have abundant supply and suspect long-term demand. And then you look at, on the other hand, commodities have weak supply and strong demand. And the bottom line is investors are always better off avoiding assets with abundant supply and suspect demand and focusing on assets with soft supply and strong demand. We think that commodities, that's pointing towards commodities, looking at commodities and avoiding US dollar and US bonds, and also in addition to commodities, looking at resource stocks again because of the long-term supply and demand situations. So that's a wrap on our commodity and chat, or our market commentary. If you're watching the show on our website, after we get done, each show will, the previous show will come up after the current show comes on, so you can watch them sequentially like that. Before closing, we'd like to stress that this show and our reports are for information purposes only. We aren't making buying or selling recommendations. It's important for you to do your own research and speak with your financial advisors before making any investment decisions. We're always trying to grow our audience, so if you could help us out with that, we'd really appreciate it. Send a note to your friends via email or however you get a hold of them, and let them know about how to find us on our shows and on our website. We really appreciate that. We also really appreciate you taking the time to watch the shows. We're well aware that everybody is busy these days, and we strive to produce a show that saves you time and brings you helpful, high-quality information. On our upcoming show, we haven't quite decided whether it's going to be on Tuesday or Wednesday of next week. We have a holiday on Monday up here in Canada. It's our Thanksgiving celebration, so we won't be having anything. Probably Tuesday or Wednesday of next week, and we'll be talking about another In the News segment. And we hope you can join us. And one of the best ways to keep track of us is by subscribing to our reports. Again, you subscribe up top there, and that way we'll send you, there's no charge for the reports, and we'll send you notices when we're doing shows. You can find all our work on our website at allanberryreports.com. Have a great day.